Welcome, everyone. As you're filing in, we're so excited to have you here. We're going to start just at the top of the hour. We're excited to have you here for our webinar, and we'll be starting shortly here. Meanwhile, if you have a question that you want to ask straight off the bat, there is the chat function, and you're welcome to type that in the chat. And we will be doing our best today to answer those questions as we go through the webinar today. All right, it is the top of the hour, so we're going to go ahead and start. Thanks for joining us today. My name is Marcia Butler. I am the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed investor advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Fixed annuities are long-term investment vehicles designed for retirement purposes. Gains from tax-deferred investments are taxable as ordinary income upon withdrawal. Guarantees are based on the claims paying ability of the issuing company. Withdrawals made prior to age 59 and a half are subject to a 10% IRS penalty tax, and surrender charges may apply. Well, now that we've got the disclaimers out of the way, I want to thank you for being here. We're thrilled to bring you this lunch hour educational presentation on making your money last through retirement. Attendees are muted. We do encourage you to ask questions using the chat box. The presenters will answer those queries during or after the webinar today as appropriate. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. Oh, my apologies, got to the wrong slide there. Mike Capriotti is a master certified estate planner and holds securities registrations through LPL Financial. He is a member of the National Institute of Certified Estate Planners. Outside of the office, he enjoys spending time with his wife, Holly, and their 3 children. He believes in giving back to his community and supports several charities, including Ronald McDonald House Charities and Make-A-Wish Foundation. Michael, we're excited about your presentation. I'm going to go ahead and turn the time over to you.
Thanks so much, Marcia. I really appreciate that. Okay. Thank you all for joining the call today. Let's jump right in. Making your money last through retirement. When the only focus in life should be the stress-free enjoyment of the fruits of your labor. So we all want not just retirement paychecks, but retirement playchecks. However, none of us have a crystal ball to predict what's going to happen in the future. It's one big guessing game. So we need to take stock in the information we already know to make the best possible choices. Some people want to ensure they leave a legacy for the next generation, and some want to spend every dollar without concern of leaving a legacy. Whatever your fancy, we need to set clear financial goals. The mind is a powerful tool. When you get clear, about what you want, when you want it, and have a strong why behind your goal, your brain can't resist. You've given it a clear target to optimize your actions around. Step one, and this is extremely important, it's assessment. We need to look at where you currently, we need to take a hard look at where you are currently. Look at your income and expenses, and we need to build a budget around that. Go through all your expenditures, especially the recurring ones. If you have current debt, we need to eliminate it or drastically reduce it, preferably before retirement. And then also we need to look at, when we talk about those expenses, your living arrangements. Do you plan on continuing to live in the same state or house that you're currently in? These decisions will be huge drivers as far as how much money you can spend in retirement. And we can look at those taxes and expenses in total. So what you're spending now is not the same as what you will spend in retirement and what those categories are. So we're really going to want to look at the total picture. We want to look at current life status, family, health, your hobbies. For example, if you're married, your spouse's current work or retirement situation, if they're going to remain in the workforce, how secure is their current position or salary? How is your overall health? Do you have any pre-existing conditions or previous injuries that you know will require frequent or occasional medical treatments? What lifestyle choices do you enjoy? What type of traveling, eating out, golfing? And will that be part of your retirement? Obviously, we've all been affected with this last year in regards to the COVID pandemic, so a lot can change in a hurry. Think health, not wealth. So healthcare is the big one here. Americans age 50 and older cite healthcare costs in retirement as their greatest financial concern, regardless of their wealth level. Out-of-pocket healthcare costs are typically more than double what the average household has saved. So we have to be aware of that. Yet the vast majority of people have not factored healthcare costs into their retirement planning. So the best retirement plan involves not just your finances, but also ways to stay mentally and physically healthy. One place you can go for more information specifically about this is Medicare.gov site. But being healthy is the most important in retirement. Obviously, if your health is compromised, you're much more likely to burn through your savings. We also want to continually optimize your health insurance. So it's important to reevaluate your supplemental Medicare coverage every year. And just to bring this up, Medicare is a government health care plan that starts at age 65. So before that, you're on your company plan. After 65, it's Medicare. Insurance companies change policies and your health changes too. So shopping for the best supplemental coverage can really save you money and improve your benefits. Long-term care is not covered by Medicare or Medicare supplemental insurance. We want to be aware of this because this could be a hidden cost in retirement that we may not be prepared for. It's all about longevity. People are living longer. So we want to also know, is Alzheimer's or dementia in the family, and plan accordingly for that. On average, 52% of people who turn 65 today will develop a severe disability that will require long-term support services at some point. And the average duration and need over a lifetime is about 2 years. So we're either going to self-insure that risk, or we're going to look at an insurance policy, whether it be a life insurance policy, these hybrid policies, where you could get a long-term care rider attached. So we either want to insure the risk, or we want to make sure we know we're self-insuring and there's enough money there to cover at least 2 years of that care.
I have a question here, Mike. About when should people start thinking about getting something to plan for long-term care? I mean, about what age?
That's a great question. I think it depends on a few things in regards to health and your own personal health. And if we look at as far as what the genes of the family are, but most people start to look at it around 60 years old. Long-term care has definitely changed from the plans that were around back in 1980 and the 90s to today, where instead of it was a long-term care, it was a use it or lose it. Now, what many people can do is do a hybrid type of plan where you could have, let's say, a life insurance policy to cover your life and use a long-term care rider, not to get too in the weeds here, but get into a long-term care rider to ensure that risk so that if you don't use it or you don't need it, the family will be taken care of with some form of legacy benefit. So it kind of kills two birds in one stone. But I would say around 60, 55 at the earliest, but 60 years old is probably a good time. When you're 70, obviously, um, health becomes a little bit of an issue with insurability. So it just gets a little more challenging depending on your lifestyle.
And of course, you were saying that if you have maybe some of those future disabilities in your gene pool, you might want to look at it based on that. I mean, I guess it's an individual situation for each person.
Yes, it is, but I would definitely advise or recommend to the people on this call, you want to do the research and check it out. And
Mhm.
then you can make an informed decision once you're educated on the total cost. Is it worth it to outsource that risk with an insurance company, or again, just have money associated with who's going to be? I'll give you one more example, Marche. Who's going to be the
Yeah,
caregiver if you have an issue? I would tell you most family members would say what I've had in my experience. Absolutely, the surviving the spouse or family member, I'm going to be happy to take care of my husband or wife through this ordeal. One thing I would say, if you're not in the caregiving field, you really don't necessarily know what to expect. It is a 24/7 job, and everybody needs a break. I just would look at really the work involved and know what those options are ahead of time. But optimum pricing for things in regards to the cost of long-term care, 55 or 60, I'd say is a good time.
that's great. And then just maybe coming back to that first thing when you talked about doing an assessment, do you recommend people just kind of get out a spreadsheet and or just do some dreaming about what my retirement's going to look like?
I think ultimately the retirement that you want to have and the retirement that you can have is going to be based on where you are currently, and if you want to be very purposeful with changes. So ideally, with any budget or current assessment, you want to jot down, these are all my sources of income today. If it's just employment income, we don't have a supplemental investment account or retirement account. This is what we have. And then what are my expenses? We can only control those two things, the income side and the expense side. So
Mhm.
either I always like to say, and everyone's a little different, there's people who have an income problem that we can address getting closer to retirement, what we can do, or a spending, I won't say a spending problem, but let's call it that, where our expenses are just way too high and we're going to run out of money based on projections within the first 5 to 10 years. So something has to change. But I would definitely put a spreadsheet together, jot that down, or have someone um, really just put down the general numbers. You don't have to be so detailed, although it would be nice if you were,
Mhm.
but to give you a general idea of, is this going to work, or do we need to start making some changes and being more purposeful for what and how we want to live in retirement.
I did have one other question here come in just about long-term care providers such as nursing homes.
Mhm.
Should retirees be concerned about protecting their investments and estate from the long-term care providers?
Yeah, so another good question. What I would recommend there, and what we recommend to many of the clients that I've dealt with in the past, is you want to coordinate with your financial advisor and an elder care attorney in regards to ways to protect your assets, cover your um, cover your risks of how you're going to pay for those facilities and protect your legacy. Now, not every, again, we be careful, not every elder care attorney is a great a place to go. You can run into a number of different attorneys. There's a very reputable ones, and some others where you might want to avoid. So how would you necessarily know that? I would at least go and visit three or get some good referrals as far as who you can speak with. But the only way to protect your assets is the planning that it would take to either visit with the elder care attorney and put something together, insure that risk so that your original estate isn't being drawn down. Or again, there's ways that you can do a spend down to where the other option is Medicaid picks up the cost. However, I would say to you, most people that I've run into or that I've worked with in the past do not want to go to a Medicaid level facility. But even in the really good facilities, there's always issues. You always really want to have somebody that's your advocate there with you, a family member to look out and protect you. No one's going to care more about you or yourself than you or someone in the family.
Thank you so much for your answer. And that kind of goes right into what we were talking about next about step three.
Yeah, so step three here, income, investments, and Social Security. So when many people think of retirement, they think no more work. But the reality is that part-time work is part of many people's retirement for income, for engagement, to give back, or for social reasons. Working part-time also gives you a hedge if there's a big market correction. So think of what's just happened this past year. Uh, Most people were stuck home when the economy was shut down in March due to the COVID-19 pandemic, and got a feeling of what retirement would be if you didn't have any more work and you just sat home and you couldn't do anything. That's not necessarily retirement or what people envision of what retirement would be. So working part-time, being out in public, uh, those those things are what I think help offset. As the market dropped, you'd have some income, something else to draw on, so you weren't pulling your investments at a rate that would be unsustainable. Recently, more people have started getting smarter and are delaying the start of Social Security benefits. However, about 33% claim Social Security benefits at age 62, which is generally a bad idea. Basically, if you think you'll have a long life, then you should delay claiming as long as possible, since you're effectively buying an inflation adjusted lifetime annuity backed by the US government at a lower rate than you could buy it on the private market. I would encourage you to have your financial advisor run some Social Security projections to optimize your claiming strategy. Now, of course, if there's a health concern or there's genes, there's not a lot of longevity in the family, or you just need the money, obviously you're going to claim earlier. But in essence, it makes sense. This is your last raise if you're no longer working. It makes sense to delay as long as possible because you're going to reap those benefits of the delayed claiming strategy till in your 90s and later. So it's definitely a good source of income. In an ideal world, your investments will generate enough income to cover all your expenses. But it's tough to make that plan work if you haven't saved consistently and live within your means both before and during retirement. So we want to develop a sane asset allocation mix. And one of the other features that are really hurting people today is this thirst or this scarcity of income generating investments that are safe. So we all know, if we've been to a local bank or we've looked at uh, bond yields, the 10-year bond yield right now today, I think maybe at 1.37%. 10 years at 1.37% really doesn't offer us a lot of income. We'll be drawing a lot on principal. So traditionally, asset allocation mixes would have been 60% in the market, so in the stock market, equity market, and 40% would be fixed income instruments, similar, i.e. CDs, money markets, savings accounts, short-term bonds. Unfortunately, the banks don't pay a lot these days. I don't know. It's been about 10 years. We really haven't received any type of yield. So it's forcing people to look at alternatives and other places where we can get income if it's possible without getting too risky. So that's something we want to diversify and look at. One other option for this is an annuity brings a guaranteed level of income. So what an annuity is, for those that aren't aware, it's a contract with an insurance company that will allow you to buy a guaranteed income stream. Now, there's many types of annuities out there, so you have to be careful. There's a lot of bad ones, and there's some good ones. But what we're talking about is we're going to try to create our own pension. Now, a single premium individual annuity, or immediate annuity, excuse me, that is where you turn over your money to the insurance company and they guarantee you a period of income, guaranteed income, and rates are low now, and that also affects what those the amount of income that they're going to guarantee for you. But there are a number of types of accounts out there that I would, again, recommend that you discuss with your financial advisor or your professional to see what is out there and what makes the most sense to provide that floor of income. So if you could have some money coming from your Social Security, some money coming from, let's say, an annuity, you have your basis covered, your basic bills that you definitely need to have taken care of, so you can sleep well at night, regardless of what the action is in the market or the day to day.
So you're saying a mix of those, and you want to have the ones that are less, that won't fluctuate with the market, be the ones that are kind of like the base of your budget.
Yeah, so ultimately what we're trying to do is replace your earnings with what you're earning through work. So we're no longer working. So how are we going to replace that income? One way is, so Social Security adds some money, but it's not going to be enough to live on. And then when you look at your overall retirement plan, whatever you may have that you've saved in your 401k, or what you may have saved outside of retirement in a traditional brokerage account, we want to look at, well, how can we guarantee a certain dollar amount? So if your bills, your absolute floor of money that you need is about $50,000 a year, I'm just using that as an example, we want to piece together a few places. An annuity may make sense to just put enough money in that asset to guarantee that income stream. So Social Security plus the annuity plus part-time work will at least give you your floor of income, your base, your foundation of your house, if you will. And then everything else is going to be more discretionary for the future, because we still want to invest in growth. If you're going to live, our life expectancy is another 20, 25 years, 30 years, costs in 30 years are probably going to be higher than they are today. So we need to keep pace with what those rising costs are. But I would say, absolutely, we want to think of them as buckets, but we want to piece together the overall portfolio to at least give you as many guarantees as possible. So we don't want you to be in your mid 70s or 80s and really worried about what's happening with the stock market today, what moves, did a specific company drop 10% or 5%? You need this money to live off of. So we want to be as conservative as possible, but still have some type of return.
About what age do you recommend people look at purchasing an annuity if that's what they decide they want to do?
So I don't normally, for drawdown strategies, you would look at that, again, similar to long-term care, 50 to 60. You certainly could look at it earlier. You certainly could look at them later. It really depends on what the benefits are and what the value of those benefits are for you. So a lot has changed in the last 10 to 15 years with them. And just like, in 2006, you could have received a fixed annuity that paid 7 or 8%. Today, you're lucky to get 1 or 2%. So I don't know if it's just age. It's also, does it really fit? Is it appropriate? You don't want to just get an annuity for the sake of getting one, but I would say you want to sit down with your advisor, discuss it, and have a plan to at least come through with, we need this much income. This money needs to throw off, let's call it $50,000 a year. How are we going to make that happen? And does the annuity fit based on current market environment? And it may not, but I don't know if age necessarily is a big, huge driver of it. Obviously, if you are retired already and you're looking for guaranteed income, that makes more of a call to action there than necessarily just age. So age is part of it, but it's not a huge factor.
I do have some other questions if you don't mind.
Yes, sure.
So one of our participants asked about, what if you don't have a 401k? Can you maybe talk about some of the other vehicles for retirement savings?
Sure. We're going to get to that in the next few slides, but just to give you a heads up, so you could do a Roth retirement if you have earnings. There's many benefits of the Roth. You could do a traditional IRA. The 401k is just if you had an employer plan. But keep in mind, we're calling this retirement because you're no longer working, but you could have money in we'll call it a non-retirement account that you're saving and investing, and you're going to use income thrown off from that account to pay you or to supplement what your income is currently. And that would be, I would consider that part of your overall retirement plan. So there's many ways to save. You have some people that just invest. I'll give you an example. And I don't do real estate, but there's many people that invest in real estate and they use that as their retirement plan. So they're going to invest in real estate, look at rental income, and that's going to be part of what they do for their retirement plan. But that's not necessarily held in a specific retirement account. So I think what's more important than just the retirement account and tax efficiency, tax advantages, is you need to be a consistent saver, and you need to find a way to put money away on a consistent basis. You will get out what you put in. So if you don't put any money into some type of savings vehicle or retirement account, you're not going to have anything in the future. I hope that answered the question.
Thank you. Thank you. If that participant wants to chime in, if I haven't addressed what they wanted to have answered, let me know. All right, we're ready to move on.
Okay, so the other piece here is we want to manage longevity risk. So one of the single biggest risks that everyone worries about is outliving their money, because no one knows how long they will live. It's very random. Now, there's a couple ways to manage for this risk, right? We can work longer. We can continue with part-time work. We can reduce lifestyle. We can limit our withdrawals. So, or a combination of all of them. One thing that I find really interesting when it comes to longevity risk, currently, you may have seen there's a lot of these DNA testing that's out there today. So I think 23andMe is one, and I don't know if Ancestry, excuse me, if that's another one that does it. But there's with new testing that's going on, there's something called biological age versus chronological age. And chronological age is just, how long we've been on the earth and we've circled the sun 365 days a year. If I'm 50, I've been here chronologically 50 years, but biologically, my body may be younger than 50 or older, depending. And they're starting to do different tests in regards to look at this. Marche, I don't know if you want to put this site in the chat, but I believe they're called telomeres. They're able to tell. Now, again, don't hold me to this, but it's really interesting where you could take a test and it could give you where you are in as far as a biological age. I believe they can do this even not just your whole body, but maybe specific organs. It gets pretty in depth. But something like this, and who knows what we'll be using in the future, but something like this can help you from a planning standpoint, saying, well, I've got really good genes. Everyone lives to about 90, 95. I know it's pretty random. I can plan for that. But it's another way to just kind of get some results as far as if you're, I won't say on track. Some people feel better at a certain age than others, and we can look at your drawdown strategy and how much you spend, because as I said in the beginning, some people want to leave a legacy and some people really don't. They want to spend as much money as they have, and if they could get down to the end and just have $1 or $2 in their account, that's what they'd like to have when it's their time to pass. So something very interesting to look through. One last thing here, step 4, don't overlook taxes. So it's an integral part for how far your money's going to go. We really want to have a tax efficient drawdown strategy. So we talked about earlier different types of retirement accounts, pre-tax and qualified, post-tax and non-qualified, and the Roth IRA. And we want to know how withdrawal from each of those different types of accounts will affect what your taxes are. And our taxes currently, because of the Tax Cut and Jobs Act, I believe in 2017, are at a much lower rate today than they have been in the past. Now, that's not permanent. That's supposed to sunset in the year 2025, 2024. But when that does, taxes most certainly will be higher. We don't know for certain, but there's a high probability they'll be higher. And if you're drawing money out that puts you in a higher tax bracket, how does that affect how far your money's going to go? If you have enough assets, right, you'll need to plan your drawdown in a way to try to avoid being pushed into higher tax brackets. So ultimately, we want to first deplete assets that are already tax affected, meaning non-qualified money, non-retirement money. Then we want to use tax deferred assets, which is qualified money or retirement accounts. And then finally, we want to use our Roth, which is tax-free money.
Can you give some examples? So that non-qualified money would be, for example?
So think of a savings account or just a traditional investment account, money you have that isn't in any type of retirement account, so that you've already paid tax on that money. So when you pull that money out, there's no extra taxes. That's not going on your income. Now, if you have to sell certain securities or mutual funds or exchange traded funds or even bonds, you may have a capital gain that you have some taxes on. But for the most part, your financial advisor, professional, or yourself, you could structure it in the sense of, well, I have this much money in very, very short term almost cash-like instruments. So it could be 1 to 2 years worth of expenses, could be less if you're not as conservative. And that's not going to push up your tax bill. If you
Mm.
pull money out of your 401k, what we see is someone may have done a great job saving over a 20, 30, 40-year career, and then they just pull a major lump sum out of their retirement account. And it's like they made, let's say they're making $50,000 with Social Security and some part-time work. And then all of a sudden, they want money. They want to fix up their kitchen. I'm going to use this as an example with everybody
Mhm.
running to Home Depot these days to upgrade the house. They want to fix up their kitchen, and they say, well, I have this money. I'm just going to pull 100,000 or 200, 150,000, 125,000 out of my retirement account. Well, that 125,000 goes right to the bottom line, and now it's like you've made $200,000 for the year. You're going to be taxed if you're in that particular bracket.
So it's going to move you up in tax brackets.
Right. You're going to pay more. And the other thing we have to be aware of is, Medicare is not free. So when you turn 65, there's Medicare premiums, and that is also based, depending on which plan you choose,
Mm.
it's based on your overall income. So there is a 2-year look back that they'll look back at what your income was. Let's say we're in 2021. They're going to look at what your income was 2018, 2019 for what those premiums are going to be. And just that 1 year could bump up your monthly premiums, and it's going to take a little bite out of what your current income from, or what you're generating as far as income from your assets. So we want to be careful and try to manage it in a real tax efficient way.
So that when you were talking about the 401k, that counts as qualified money, correct?
Well, so 401ks today, you can have a Roth 401k. It depends on your plan. It depends on your company. So there are Roth 401ks, which means it's after tax money.
Mm.
But keep in mind, the company's contribution will always be before tax because the company wants the tax break up front. So you could have some money in a Roth 401k. Again, that's after tax. Those distributions will not count against you in regards to bringing up your overall income or counting against for Medicare premiums, anything coming from the Roth. So it's a very tax efficient way to draw money out without being hit, bouncing you into a higher bracket or stepping on some type of tax landmine.
Thank you. Thank you. That helps a lot. All right. I think we're ready to move to the next part.
Okay. And then lastly, we want to find the right financial advisor. Personalized financial planning at any life stage is crucial. There's no such thing as a one-size-fits-all approach for financial security. You'll need as much good advice after retirement as before. With a financial advisor, you'll spend and save more wisely. And research has found that boomers, so these are baby boomers, who are working with a financial advisor are twice as confident about having sufficient savings for retirement than their peers who are planning retirement on their own. Doesn't mean it can't happen, but I always go with a trusted professional, someone who can guide you through, that's been there and sees it every day. It's definitely worth it to have someone good. Now, again, you need somebody that's trustworthy, listens, values the things that are most important to you. You've got to find that right fit, but very, very crucial. And the dollars that you will have or save, or the taxes that you won't pay, which is hard to measure beforehand, are very worth it. I am a little biased because I'm an advisor, but I would say, just like any project, you could do it yourself. You just have to put the time in and really research and know what you're doing. And you can't, you have to do it full time. So that for the most part concludes our presentation, or my presentation today. Are there any other questions or concerns that you might have?
I do have some questions here, some specifics. So I know that this is just kind of general guidelines, and I would advise this person here who has asked, we don't give specific advice, but definitely like we can take this as an example here. So the question is, my wife and I are in our mid 30s now with kids, and we're debating whether we should add life insurance to our expenses or not, so that we can plan or budget for that as well.
Yeah, well, I'll tell you this. I mean, insurance is tremendously important. So, depending on, and again, this is your specific situation, I would tell you, and um, I just had experience with someone in their early 30s. This was just last week, actually.
Mhm.
Two kids, younger children. So I mean, 3 and 1, and really looking at, I would tell you, depending, if you're not a smoker and you're insurable, absolutely hands down, you want to protect for catastrophic loss. So you or your spouse, let's say you get hit by a car, something happens, it could totally, if you don't have insurance in place, it could totally upend their life. I mean, it's going to be hard enough losing a significant other than having to move out of whatever house, move back in with a family member. It could be bad. So I would say to you, unequivocally, absolutely, insurance for someone young, especially if you're not a smoker, and even if you are, it's okay. I would be looking at some form of term insurance if cost is the key, and look at a 10-year term is probably the cheapest or most economical you can get. So just cover, rule of thumb can be 10 times, 20 times what your salary is. You don't have to go that high, but the numbers, it's really, the cost is so worth having the, at least on the budget, than not having it. I mean, you could be looking at a couple $100,000 policy that might be $20 a month. I mean, in my mind, as a planner or advisor, if you want to see what you have with your employer, because you
Mhm.
might have 1.5 times, 2 times, 3 times your salary with the employer. You may not. Check that, see what the overall amount is. But absolutely, hands down, you want to get insurance. The best way to do it, I would say, early on, without looking at specifics, a term policy, 10, 15, 20 years. The cost will be as low as it can be. And really, you're just covering catastrophic. And then maybe you're in a better financial position, let's say 5, 10, 15 years from now, and you can get another policy to cover more if you want to think legacy. But I would at least cover until the kids are, I wouldn't say totally through college, but at least in their mid 20s.
And we have some more questions coming in. What would your recommendations to diversify assets into, considering my spouse and I have dividend paying stocks and mutual funds and contributions to 401/403? If we want to expand our finances to invest into something more aggressive that generates revenue now, rather than looking to a long-term purpose only.
Yeah. So that's pretty specific, and I don't want to just off the cuff that. I'd have to know where everything is, just like any advisor would, to give you a specific plan of attack for you want to incorporate some of these other investments. I would say, ultimately, you could try to reach out to me offline, and I might be able to give you a little more specifics there. But for general, for the
There
amount.
are ways to invest more aggressively. It just we need more specific one-on-one time.
Yeah, that one, there definitely are, but you always want to protect. I'm a big believer, you want to protect your downside. You don't
Mhm.
want to, and the reason I say this, you have to be careful. I mean, today, however you feel about there's a lot of crazes out there
Mhm.
today, a lot of different, whether we're talking about Are there going to be different currencies with this cryptocurrency? Is it real? Does it exist? Are people accepting it? Is it just a store of value? Like gold, when somebody says aggressive or conservative, we just have to be real careful. And I would prefer to take something like that offline to give you something specific.
Yeah, that's great. Thank you for
Yeah,
directing
sorry
that
about that.
question. No, it's it's all right. And if people do have questions, that's something also at Advice Chaser. Uh, we'll talk a little more about that. We're not financial advisors, but we certainly do match you up with one that we think will be the right fit for you. Here's another question. What type of questions do you want to ask in finding an advisor you can trust?
I think what you want to ask are a couple things. First, how long have they been in the business?
Mhm.
Do they specialize in anything? So are they general in nature, or do they have some form of specialization? For example, so I've got a master certified estate planning designation. It just means, again, I took a test and I've got some proficiencies in estate planning preparation. Now, I'm not an attorney and I can't practice law, but um, I understand what the estate plan does, and I understand what the attorney, how they speak and what they're trying to do. So an area of interest that I took, that I wanted to go into. So ultimately, if someone just is starting out, we want to know, well, okay, what type of credentials do they have? And even more importantly than just the credentials, because it could mean they just passed the test, not just how long they've been in the business, but what are they planning? What other referrals can they give you of clientele that they're working with? I think that also helps. And then, you want to find out, there's a different level of advisor that works with uh, different clientele. I mean, maybe that might be the best case. And you want to see if you're a good fit for that advisor and if that advisor is a good fit for you. So you're always going to interview them, but it's more than just okay, here's my assets, here's everything, manage it for me. There should be some a two-way communication there. But ultimately, how long they've been in the business. The other one, do they plan on staying in the business? Because let's say someone's been in the business for
Mm,
35 or 40 years, are they going to be retiring on you and hand you off to someone else? I mean, I think you want to try to ask that, is that the person that you're going to deal with? So ultimately you talk to them. Are they going to have that you're just dealing with 4 or 5 different assistants and you never talk to that individual again? So um, those are a couple questions I would ask, and that should help. And then as far as also investing, are they able to do multiple types of investing, or again, what are they just we would call it proprietary, and all they can do is one thing, and they're not going to be able to give you the advice that you need, the independent advice that you need. So for example, you might find an advisor at a local bank. Well, some of those advisors that very good, but they may be restricted for what they can offer you, because that's what the hierarchy of the bank has said they can do. So, if you could find someone independent, um, that ultimately helps. But those are a few of the questions I would see. You want to see if the advisor is a fiduciary. Another a
Can
big
you
question.
explain really quickly what a fiduciary is?
Yeah, fiduciary just means, for the most part, the advisor has your best interests at heart. So everything that they do is based on um, your needs and what you want. And actually, because if they are a fiduciary, they're held to a higher standard, where the individual could actually sue the advisor. So it's a high legal bar that they have to uphold. So that's what I would
Thank
go
you.
with.
Thank you. Well, folks, we're coming up to the end of our webinar here. And first of all, I want to thank Michael so much for being our presenter today. And we want to thank the organizations that have made it possible for us to have this webinar today. Look for an email with a link for the replay of this event in the next few days, and you're welcome to share that replay with your friends and your family. Here at Advice Chaser, we're all about helping you find a financial advisor who is a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com, clicking on the link to find an advisor. Once again, from Advice Chaser, I thank you so much for coming. We'll see you at another webinar soon. And from Advice Chaser, have a great day.
Take care.